So one of the concepts you will hear financial planners and investment advisors talk about a lot is that of diversification. And, if you watch Jim Cramer's TV show, and I used to work for Jim Cramer. I wrote for TheStreet.com for many years, and Jim was great, and I think he does a great job with his show. He's a very good stock analyst. But there's one thing he does that I think could be a little bit misleading when there's a segment on the show, at least there used to be, I haven't watched it in quite some time, where people call in, they tell Jim what stocks they own, and he tells them whether or not they're diversified. And usually the stocks people own tend to be a batch of large cap U.S. stocks. I'm just making some up here, like Apple, ExxonMobil, United Health, Pfizer, Amazon. Right. So you might have in that batch I just named, you had like a health insurer, you had some pharmaceuticals, you have some techs. It's a little bit diversified according to sector and industry. However, they're all large cap U.S. stocks. So that's all called one asset class, large cap U.S. stocks. You might have heard the S&P 500. I talked about that in yesterday's video a little bit if you want to go back and look at that. Basically an index of the 500 largest U.S. companies. And if you only own big U.S. stocks, you are not fully diversified. So let me show you what we've got in front of us right now. And this is a number of different ETFs, 4 different exchange traded funds, each one tracking a different type of asset class. So the first one here, you see AGG. That's a ticker for an exchange traded fund, the aggregate bond fund. So it's corporate investment grade and investment grade bonds, some treasuries, but very investable bond asset class. And what you see here, this is a chart from the past year, 12/14/21 through today, 12/16/22. And you do see, we all know it's been a very volatile year, and you see at certain times, right here, the top performing asset class, like in June, back over the summer, and in October, and right now, as we go into the last part of 2022, bonds are returning more than the SPY right here, the S&P 500, which I just mentioned. Now, large cap U.S. stocks have performed very well over the last decade. I'm just going to go back here and show you something. I hope I can do this. Yeah. Okay. So you see over the last decade, the SPY, which is the ticker for the S&P 500 ETF, far and away, that has been the best performer over the past decade. You had a little blip back here in 2018 where small cap stocks, okay, small United States-based companies, little blip back here, they did better. Little blip in 2017, they did better. I think you had a couple periods of time, maybe when the smaller companies did a little better, but for the most part in recent years, and especially ever since the whole pandemic big decline in 2020, large cap U.S. stocks have been the clear leaders. And then down here, you see over that longer period of time, bonds have not performed as well. And that last one there, EEM, that's emerging markets. Now, emerging markets can, in certain periods of time, outperform developed markets. So the United States, Western Europe, Japan, Australia, all the industrialized economies. You do see that sometimes these emerging economies, some of them in the Middle East, in parts of Asia, in Africa, Latin America, they're younger. The economies themselves, they're kind of working on their financial regulation, so they don't have the same type of evolved, sophisticated markets that some of the developed nations have. I mean, the United States, the stock market, has been around since the 1700s, really. It was formed in New York under the buttonwood tree. You can look this up. But a lot of these other markets are now kind of getting their banking systems, their currency exchange systems. So that's why they're called emerging markets. They're not as far along as some of these other economies, and they don't have as much industry, as many publicly traded companies as as strict regulation as we have in some of these developed markets. Okay, at times that those emerging markets can do better. That has not been the case in the past 10 years, though. Okay, so let's go back to the past year. Let me try to do this without, there we go. Got it. So why am I showing you all of this? What is my purpose here? What is my point in showing you this? Let's come back to the idea of Jim Cramer and diversification. Let's say you opened an account in the past year and you had all of these. You had high quality bonds. You had the S&P 500 representing large cap US stocks. You had small cap stocks and you had emerging markets. You would have had some times when some of these different asset classes over the past years would have been outperforming each other. And in fact, there was a period of time back in January and February of this year when emerging markets were outperforming all these other asset classes. So it did happen. Okay? The purpose is you want to capture these returns when they occur. Because if you're not fully diversified globally, by large company, small company, and not just stocks, you also want some bonds. And the reason to have the bonds is so that they can do what's called dampen the volatility of stocks. In other words, you see right here, this happened back in the summer. It's actually happening right now. The S&P 500 has been declining again in the past few sessions. All equities have. And the bond market is kind of absorbing some of that slack. So not all your asset classes are declining at the same time or at the same rate. And that's the general theory of diversification. Let me show you one more thing. So this is a very interesting slide. It's from Dimensional Fund Advisors. They don't use it anymore because it kind of appears to be outdated. When I showed this to my dad, he said, "Oh, it's outdated." It shows a specific period of time to illustrate the point that I've been discussing today. So between January 2000 and December 2009, which of course included the whole subprime mortgage crash, that whole big market meltdown that happened between late October 2007 and before the time the rally started again in March of 2009. So some of us who have been in the market a while, we remember this. And what this shows you is how these different asset classes performed and why, if you'd only been in the S&P 500, and a lot of U.S. investors only own big American stocks like the kind they call in and ask Jim Cramer about, right? If you had only owned the S&P 500 during this time frame between January 2000, December 2009, your portfolio would have declined 9.1%. Full stop, okay? Now, if you'd owned some small cap value, smaller cap U.S. stocks, very specific, those were up 231% during that time. Large cap value, even some large cap U.S. stocks were up 48% during that time. What's interesting was growth stocks did badly during this period of time, exactly the opposite of what's happened post-pandemic, when growth stocks, U.S. growth stocks just took off. During this period of time, U.S. growth stocks underperformed, and value, some of the more beaten down ones that you could have bought at a lower price relative to their earnings potential, some of those were actually performing better. So that group, large cap value, was up 48%. Real estate investment trusts, so investable real estate that you could buy through an ETF or a stock, up 175%. International, up 27%. International value, again, those beaten down international stocks, up more than double. International small cap value, 234. Emerging markets, we just talked about those, up 202%. Emerging markets value, beaten down emerging market stocks that you could have bought cheaply relative to their earnings potential, 413.79%. Okay. Bonds, 57%. More bonds. This is a Barclays government bond index, U.S. government bonds, up nearly 82%. So you see the point. Is that those who had stuck with what they know, the large cap U.S. stocks, those very familiar names that we all hear about all the time, doesn't always lead the way. You have to kind of parse your portfolio a little better than that. Hit me up with any questions. Reach out here. Happy to help you. I hope you found that helpful today.